options trading strategy, LEAPS. LEAPS stands for Long-term Equity Anticipation Securities. These are publicly traded options contracts with expiration dates that extend significantly longer than standard options, typically up to 3 years from the date of issuance. While they function identically to standard monthly or weekly options, their extended time frame shifts the strategy from short-term speculation to long-term investing and hedging.
Core characteristics of LEAPS. LEAPS are available on thousands of individual equities as well as major indices like the S&P 500. Expiration. Usually expires in January of the following 2 or 3 years. Cost. Because of the significant extrinsic value, time value, LEAPS are much more expensive than short-term options. Ticker symbol. In most trading platforms, LEAPS are listed alongside standard options, but are distinguished by their distant year of expiration. 2. Common LEAPS strategies. A. The stock substitute strategy. Instead of buying 100 shares of an expensive stock, a trader buys one deep in the money, ITM, LEAPS call. Goal. Gain 100 share exposure with a fraction of the capital. Leverage. The delta factor. Traders often look for a delta of 0.80 or higher. This means for every $1 the stock moves, the LEAPS contract moves approximately $0.80. B. Poor man's covered call, PMCC. Technically known as a long call diagonal debit spread, this is a popular way to generate income without owning the underlying stock. Long leg. Buy a deep ITM LEAPS call, expiring in 1 to 2 years. Short leg. Sell a short-term out-of-the-money OTM call, expiring in 30 to 45 days. Benefit. The short-term call premium offsets the cost of the LEAPS, and the time decay, theta, works in your favor on the short side while being negligible on the long LEAPS side. C. Long-term hedging, protective puts. Investors holding a large stock position can buy LEAPS puts to act as long-term insurance against a market crash. This protects the portfolio for years rather than weeks. 3. The Greeks and LEAPS. The behavior of LEAPS is governed by the same Greeks as standard options, but the magnitude is different. Theta, time decay. The primary advantage of LEAPS. Time decay is nonlinear. It accelerates as expiration approaches. LEAPS lose value very slowly in the first year, making them sturdier than short-term options. Delta. High delta LEAPS behave almost like the underlying stock. Vega. Volatility. LEAPS are highly sensitive to changes in implied volatility. Because there is so much time left, a small change in market volatility can lead to large swings in the LEAPS premium. 4. Pros and cons. Advantages. Capital efficiency. Control 100 shares for 10 to 30% of the stock price. Disadvantages. Liquidity. LEAPS often have wider bid-ask spreads than monthly options. Advantages. Lower theta risk. You aren't fighting rapid time decay every day. Disadvantages. No dividends. Option holders do not receive dividends paid by the company. Advantages. Extended timeline. Gives the trade more time to be right if the stock dips temporarily. Disadvantages. High premium. Requires a larger upfront cash outlay than short-term options. 6. Tax implication. U.S. focus. If you hold a LEAPS contract for more than 1 year before selling it for a profit, it is generally taxed at the long-term capital gains rate, which is typically lower than the short-term rate applied to standard options trading. Consult a tax professional for specific advice.